Good afternoon, everybody. Welcome to our Dividend Assets Capital webinar series. I'm Jim Haley, the CEO of Dividend Assets Capital, and I'm glad you took time out of your day to join us. I'm very honored and excited and thrilled to have Matt McKenzie with us today. Matt has a tremendous background. He is the president and principal of Tom Brady Senior and Associates. He's got a great background in insurance. He's responsible for setting the vision and the strategy for Tom Brady Senior and Associates across the country. They're a national practice. He's got nearly 28 years experience in working with families, individuals, entertainers, business owners, helping them meet their advanced insurance and planning needs. He's a national renowned speaker. He's got a nice background and accolades in that area as well. And what I like most is he spends his off time when he has his off time giving back to the community. He's involved with the Rose Bowl. He's involved with the Ukes kids. He's involved with the Concussion Legacy Foundation. I think there's a few others there, Matt, as well. So, and the topic of today's conversation, as I think many of you are joining us for, is private placement life insurance. It's very much a niche offering for the right situation and for the right family. It can be very powerful and very impactful. And what I'm proud to announce today via this call too is Dividend Assets Capital has been approved as a separate managed account specifically for private placement life insurance. So that's part of the reason why we're hosting this call today is to make that announcement. And I'm also very proud to be building a nice relationship and rapport with Matt and his group too. So without any further ado, I'll turn it over to Matt and he can introduce himself further and take us off in today's session. So.
Great. Thank you, Jim, and thank you all for having me today. I really appreciate it. So as Jim mentioned, my firm, Thomas Brady Associates, we're a 58-year-old national independent insurance brokerage firm. We focus really in the areas of life insurance, disability insurance, long-term care, and working around estate planning, business planning, insurance audit. Today's topic is around private placement insurance. Reason we thought this would be an important topic to bring to everybody is I've been telling Jim and his colleagues for the last 6 months that in 28 years in the business, this is the first time in my career that this topic is being brought to us. Clients coming to us saying, "Hey, educate me on this. We've heard a lot about it. What is it? It seems too good to be true." If you look up all the stuff in Washington, this has gotten a lot of press the last 3-4 years, and we want to be proactive and educate clients and centers of influence on what this is, why it's important, and where you might see it fit in your overall portfolio. So to start, I will say private placement insurance is not new. Like I said, I've been in the business almost 30 years. It's been around as long as I've been in the business. It is a accumulation wrapper. It is a variable life policy that allows you to accumulate cash value. And most of the people focused on this type of asset class, I will say, look at it more for the cash accumulation than they do death benefit. When we say the words life insurance, I think the first thing people gravitate towards is death or death and taxes, term life insurance, family protection, income protection, estate protection, estate liquidity. Private placement really is, in my mind, a wrapper around an investment portfolio with more of a primary focus around protecting against income tax, capital gains tax, 1099s, K1s, et cetera. So where was it? Where is it? Private placement in the 1990s was really designed as a way to give the ultra affluent some better funding options for insurance. And so again, we know the death benefit side of insurance, but some of you may or may not know that life insurance has a lot of living benefits built into it. Money goes into a life insurance policy after tax. Cash value grows on a tax-deferred basis. And then if designed properly, you can create tax-free streams of income out of these portfolios. So you might have heard agents talk about the super Roth IRA or the 401k lookalike. Really using insurance as a retirement plan or as a cash accumulation plan. Well, why isn't it being done more often, right? Why aren't the ultra affluent putting more money into these types of plans if they are so tax friendly? Well, when you start looking at the different product types out there, you've got your traditional whole life, Northwestern Mutual, New York Life, Guardian, Mass Mutual, et cetera. where your investment portfolio is made up of the general account of the insurance company, which, no disrespect to any insurance company, but you're typically looking at a consistent 4 to 5% return. Not that that's a bad thing, but again, ultra affluent, when they're using insurance as a tax shelter, you're typically not sheltering the cost of insurance against the cost of tax and really picking some type of fixed income bond type of account. Then you look at variable life or index life or something that might accumulate a little more cash value. Again, no disrespect to the fund families out there, but when you're sitting with a single family office and you're talking about deferring money and growing it tax-free and accessing it tax-preferred, they're typically not looking for the American Funds Growth Fund or the Fidelity Mid-Cap Fund or the Franklin Templeton International Fund. These are more generic mutual funds that you would see inside of life insurance, annuity, or even 401k portfolios. And so what the insurance industry did in the 90s was they said, okay, if we can go out and get some real high-end money managers to allow us to put them in this private placement vehicle, private placement being accredited investor, ultra high net worth, minimal fees in the product, no surrender charges, let's really give them something where they can kickstart this as an investment. And so over a 30-year period, there's groups out there that have built these what's called insurance dedicated funds. And, speaking frankly, I will tell you, if I showed you the 75 funds that have been built over the last couple of decades, it's not very appealing, in my opinion. We had fund managers like Millennium and Golub and Bain Capital and some others that were very good. Today you're seeing firms like Apollo and BlackRock and Blackstone. There's some really good insurance dedicated funds. But over the last couple of decades, other than if you were buying a Millennium or a Golub or a Bain, you were pretty much looking at a roster of independent registered advisors, RIA types that were more playing defense from guys in my space, in the insurance space, saying, well, if an insurance guy is going to go out and get somebody to invest cash into an insurance vehicle, why don't we have a fund that's available so we can say, hey, no need to take the money out of ABC company. We'll keep it right here. If you look at the investment returns inside of these typical funds over the last decade, they're not very good. So again, we saw a lot of movement with Golub and Millennium and a couple of others, but not much there. So, if we were sitting here 5 years ago and somebody said, hey, let's talk about private placement insurance, I would tell you, conceptually, it's a good idea. The funds are limited. Not many people are doing it unless you're like one of these 2 or 3 funds. And, I would say the majority of it is because the investment just doesn't appeal to them. So what's the solution? End of 2021, the insurance companies took a step back and they decided, instead of having just these insurance dedicated funds, that we should change the philosophy inside of these wrappers and maybe start hiring fund managers. Let's hire financial institutions, registered investment advisors, banks, multifamily offices, folks that these high net worth clients trust and depend on to manage the money in that wrapper to make it more appealing. So this was a really big change for the insurance industry. Now instead of just wrapping one fund where one size fits all and doing your due diligence, you're now having to do due diligence on a financial institution that has a full range of investment types to go to. And so end of 2021, these separately managed accounts were approved. And there's a couple of firms out there that are building these portfolios and getting these companies approved. I can say Dividend Asset Capital is one of about 60 out there that are approved now. This is moving very fast, but it is not something for all. I will tell you, registered investment advisors with $500 million of assets and a middle market clientele, they're not going to be put on this. It has to be a very reputable institution with the right clientele. Jim, Mark, team can tell you they've gone through a rigorous process with the insurance company, collecting financial documents, corporate resolutions, articles of incorporation. Who's your custodian? What are your investment philosophies? What are your alternatives that you invest in? And really getting a sense so that they could pass the smell test with the insurance company and become that investment option. So, here we sit now, say 4 years later, since this change in the industry, there are about 60 firms that are actively built. There's probably another 30 that are being built. And I will say again, we're doing this more proactively to say, was something in my world that was going to be a bit of a niche. It was going to be, hey, this is a new solution to bring out to clients. It is probably the most time consuming piece of our day right now, because think about it. If you can wrap your investment portfolio with your manager into something that creates a lot of tax savings, that's appealing. So that is sort of the where we are now and why private placement is important. What I thought I would do next is really share with you, well, where are we seeing it utilized?
Yeah.
And so I would look at this as there's really three areas. I mean, there's more than this, but three areas that we are seeing as very popular. One, nothing sexy about it, but it's really what we're calling kind of our rescue program, right? There's a lot of product out there. When you hear the words insurance, I say to people, if this were called private placement Roth IRA, I think we would get a lot more focus on this than private placement insurance. Insurance always sort of catches the, well, what's the catch, right? What's the insurance element? And so again, we're using the insurance because of the tax efficiency. We want those tax benefits, but there are also all sorts of insurance products out there today that people are stuck in. The biggest one I throw out there is annuities. I think annuities are one of the more oversold products in the industry. Clients end up having them, and you look at them years later and say, do I need them? No. Well, the problem with an annuity is it's not a great wealth transfer vehicle. You put $1 million into it, you grow it to $3 million. When you take the money out or when you die with it, you're going to pay income tax on that gain. And when you typically look under the hood of an annuity, you're going to see there's 300 to 400 basis points of fee structure built in there. So you're getting gouged on future tax and you're getting gouged on fees today. We can take a product like that today and we can roll it into one of these separately managed accounts and have that money managed by the financial advisor. So in this case, Dividend Assets Capital has a client with a $3 million annuity with $1 million of basis. There's $2 million a gain. We can do a tax-free rollover from that insurance company with that annuity and give them control of the money to invest. Beauty of that is you didn't pay tax on the rollover. You've cut the fees down by probably 60 to 70% because you're not taking all these insurance company rider fees. The downside is it's still in an annuity bucket. So at the end of the day, we can't change that. You're going to pay taxes at some point in time. But I will say it's opened up a lot of discussion around philanthropy. And let's talk about your estate plan. And if you are philanthropic, this is a great bucket to identify as something you can use for that. Life insurance, same thing. We run into clients who are in their 60s or 70s, and they've got these whole life policies that they bought when the kids were younger, and now they're sitting on $2 million of cash value. They don't want to surrender it because they don't want to pay tax. This is a great way to roll that money into your portfolio and allow your money manager to work on that. So before I get to the second one, Jim, anything there I missed or anything you'd like to add?
No, I think it's absolutely what you talked about there from the rescue. We've actually had a number of clients who have looked at that and have old annuities with basis that we have actually, because of this relationship, been able to at least explore the possibility of using private placement variable annuity. And there is one thing that's still left there is if you structure the beneficiary correctly, it's the only vehicle remaining where you may be able to offer a stretch option to son, daughter, grandchild, or whoever, if you structure beneficiaries correctly. So, for those who are not charitably inclined, but do want to leave an asset to the next generation where they could stretch it out over their lifetime, PPVA is still an option for that too. So,
yeah. No, and I think the whole life stuff is important. I mean, we had a single family office out of the Midwest that, they did such incredible estate planning that mom and dad were sitting on a $60 million policy, whole life policy for estate taxes. And you fast forward 30 years later, their estate was shrunk down to the point they didn't really have an estate tax. So the kid was looking at this policy and saying, man, there's 25 million of cash value here. What do I do with it? And, this was a great opportunity to say, well, within that legacy trust, let's roll the cash value into an investable portfolio. We'll keep it in the insurance wrapper. The insurance is less of a focus now, and we'll let you manage it in equities, bonds, alternatives, whatever you feel. And over mom and dad's life expectancy, it created a really nice value for a family that thought it was a dead asset. So second area I would say is where I thought this would be the most popular concept. So think of it as, again, the client who, I don't want to say they're ignoring estate planning. It's not that they don't care about death and taxes of their kids, but they're more focused on, talk about me. Talk about the fact that I've got this alternative investment that I paid 2 and 20 for. I've done really well with it, but I get the K1 every year. You know, my 20% return after fees and taxes ends up being 8%. It seems like a lot of hoops to jump through, especially waiting on that K1 every year. Well, what better type of investment to put inside of a wrapper like this is than one that, you know, eliminates K1s or eliminates 1099s. And so this is really where we're seeing a lot of uptick. I usually tell people, is private placement for you? Well, if you told me you got a pretty generic vanilla portfolio where you've got a bunch of muni bonds and a bunch of buy hold strategy equities that'll step up in basis at your debt, this probably isn't the best vehicle. But if you've got a highly taxable brokerage account and you're looking at this as, man, what would life look like without these K1s and 1099s? This is a great solution. This is happening all over the country. I would say the majority of people that are doing it are really looking at alternatives. We are seeing tons of private equity, private credit, venture capital, hedge fund, private real estate, those types of investments go into a wrapper like this because of the tax efficiency. So this is someone I would say is between 25 and maybe 75 years old, very focused on their portfolio. We get the question all the time of, because it's insurance, does it belong in an irrevocable trust? Not necessarily. I mean, I would say we're doing these in revocable trusts. We're doing them personally owned. We're doing them in spousal lifetime access trust, legacy trust. It really comes down to, where do the assets sit today and what are we trying to make more tax efficient? So there's no right or wrong answer as far as whether you control it or whether, you know, the trust controls it. The third item that we're seeing a lot of, and this is a surprise to me, is more the ultra affluent. So, you know, as somebody who does a lot of estate planning and a lot of insurance planning for the ultra net worth, you know, there does hit a certain level of net worth where you say, is insurance part of the solution? I mean, it's always an option, but it's never the option. When you've got clients in the $1 billion plus range, insurance is a real small fraction of what we can ultimately do. And the reason for that is, if Jim and Mark are both worth $2 billion and we talk to them and say, you've got a major tax liability, obviously we're going to work with the attorneys and accountants and family office. We're going to do discounts and sales and, you know, get as much out of the estate as we can as possible, right? When it comes to the insurance element, though, I'm probably going to cap out in the reinsurance market and with insurance companies' capacity at somewhere around $250, maybe $300 million if I'm lucky. It's a lot of money, but again, for somebody who's worth billions, it's all relative. It's, you know, it's only going to be a fraction of it. So we didn't see much activity there, whether it was a sports team owner or a huge manufacturing brand or a big real estate family with billions of dollars of illiquid property. Insurance was always a limitation. Where private placement comes into play is, I'm sure some of the folks on the call here are doing incredible estate planning. As you're moving money of your clients out of the estate and you're creating wealth off the balance sheet or off the taxable estate balance sheet, the opportunity here is, using private placement as a wrapper in that legacy trust, we can not only leverage it up on multiple family members, but we can also eliminate or reduce a major issue with those gifts, right? So if I take $1 and I move it to my legacy trust today and it grows to $100, I don't get a step up in basis. I've got the basis of $1. Well, if I move $1 out and I invest it in a private placement wrapper and it grows to $100, upon death, this is a death benefit. So it is considered, even though we're not buying it for life insurance, it is considered a death benefit, and that fully steps up in value, and the basis equals the death benefit at the time of death. So we are seeing a lot of families, a lot of ultra affluent multi-billionaires that'll say, so who's the insured, right? I mean, the patriarch is 91 and the matriarch's 89. Like, they must be far past insurability. We don't care about who the insured is in these types of situations. We care about that there is an insurable interest and that it helps the overall planning. So in a situation like that, we might have $25 to $50 million of investable assets go in on son one, son two, daughter one, daughter two, 4 grandkids. I mean, we're seeing families that will utilize 15 to 20 different family members, depending on how much is out there. So, you know, again, why do it? Well, it really is just that tax efficient tool. Couple other things I want to hit. So those are the 3 areas, but a couple things I want to hit that I think are very important with this are, well, what are the don'ts, right? I mean, I'm giving you a lot of positives here. What are the don'ts? One don't I would say is, if you Google this, you will see that investor control is the biggest no-no. And this is the biggest thing that I see people trying to abuse in this type of wrapper. By investor control, We're simply saying Mark is going to hire Jim to be the money manager inside this private placement wrapper. We cannot put Mark's business in there. We cannot put his personal real estate portfolio. He is a managing member of a private equity firm, and the first thing he asks is, "Can I put my carried interest in here?" We cannot do that. He has control over it. We do not want Mark calling Jim on a monthly basis and saying, "Sell X and buy Y," or, "Hey, my friend just brought this new investment portfolio to me, and I think we should add it to this portfolio. Let's do it." Really, what we're saying is this is an arm's length transaction. I can have Mark as the client sit with Jim and say, "I really like what I heard with private placement. I would like you to put a portfolio together that's heavily focused on private equity and private credit. I want these types of assets or these types of managers," but then you are taking a distant view and allowing your money manager to do their job. And I think this is important because, again, I mean, we get calls on this on a daily basis, and it's like, got a situation. I got a business out of LA. I'm the sole owner of it. I'm going to create a management company. My wife's going to own that. I'm going to own this. We're going to sell it. We're going to avoid the, issues with investor control. If you start hearing stuff like that, this is where we're going to get into trouble. So that's what number one I would say is the no-no. Number two, when I talked about the rescue, we cannot use qualified money. So people who have annuities and IRAs or they have pension insurance policies, this is all non-qualified and is starting with, other than the rollovers of insurance policies, all new money. We cannot have a client call and say, "Did a venture capital investment 3 years ago. I just got an update. It's worth 30x and it's probably going to liquidate in a year. Let's roll it into the wrapper." We're starting with new money. Reason I mentioned this one is I got a call last week where somebody said, "Check out this article. I did hear from one of your competitors and they are telling me I can do it." And the person literally wrote black and white, "You can take in-kind asset transfers." Well, where is he doing it? Because we can't do it here. Of course, he was doing it in Bermuda and the Grand Caymans and using international companies. And so, there's a lot of stuff with these insurance vehicles where I will say to people, there's what you can and can't do, and that there's what you shouldn't do. I will say there's a lot of companies that will toe the line and say that don't cross it. This is a good spot. That's us. We're saying stocks, bonds, alternatives, do it the right way, and you'll always stay out of harm's way. Those that are saying don't worry about investor control, take it offshore, let's do currency swaps. That's the stuff where I would tell you you're gonna get caught and pay a decent penalty in the future. Last thing I would throw out with the do's and don'ts and sort of why haven't more people done this? I mentioned that there's about 60 firms, including Dividend Assets Capital, that are built. That number's probably doubled in the last year. And the guy who builds these things, that is a good friend of mine and Jim's, he's got 30 more in-house. I mean, they're growing fast and furious. There's probably 10 to 15 of me in the industry that actually are doing this stuff consistently and know what they're doing with it. And so I think the biggest thing is education, which is why we're being proactive here on this call to say, let's go out and make sure that if any of you hear about this, it's not the first time you've heard about it. Or a lot of times it'll be, "Hey, Matt, I've heard about this from 3 different clients, but I've never really run into it. How does it work?" That's really the goal today, is to educate, to say it is out there, it is legit. There are some potholes that you got to be aware of, but if done properly, I will say that the ultra affluent are looking at this as, where has this been all my life? This is a great, great tool. So let me pause there. Jim, anything to add to that?
No, yeah, and it's the ability to, as you look at this, as I sit here and think about some of the clients that we have that could potentially have an interest in this. Okay, we have clients here who have these old trust accounts that have low basis in them, that we are having to do planning work every year to try to rebalance and for us to put a strategy together to peel some of that off into a PP into something like this with inside that old trust and have all that be tax deferred and then grow over the next 15, 20, 30 years and have that be stepped up at basis. That's some of the stuff that we are, as we continue to move forward with this and some of what you've explained, is where the benefit I see is some of the client base that we have. They have all these old trust accounts and low basis. And this could be an opportunity for them to take some of that, not all of it, but a portion of it, and allocate some of that to private placement. And do that in a way that's still passing generational wealth, but doing it in a much more tax efficient way. And that's a huge benefit I see for this as well. And,
Yeah, no, that's a great point. I think people ask me all the time of like, what is the right net worth level? When do you start investing in this? How much do you invest? And I would say the goal here is not to say take your entire portfolio and throw it into this. It's be selective about the inefficient, taxable items that let's make sure those are here and the tax efficient investment items stay where they're at, right? Because you are paying a little bit of a premium for this. You're paying 1.5%, let's say, all in to create the wrapper or actually manage the wrapper, where the reality is that's a great thing because you're offsetting 20 to 30% of capital gains tax depending on where you live. That's great, but you're not going to put, again, a municipal bond in there where you're already getting this tax benefit. So, I would say for me, rule of thumb, and there's always room for discussion around it, but usually 20, 25 million of net worth. I usually say somewhere around upwards of maybe 10% of the portfolio, depending on how that portfolio is built. That's kind of what we're seeing out there. Now with the ultra affluent, where you've got all the money in these legacy trusts, we're seeing larger portions go into it because again, we're not taking the money away from the asset manager. We're simply wrapping it and making it a more useful tool for them.
that's right. And then you can talk about too is that you're not doing this to you're buying death benefit as well. But so if you were to put 5 million in, there's potential there you're buying death benefit of how much if someone were to over 3-4 years allocate 5 million. What's the type of death benefit they could look from this as well?
It's going to vary by age. I mean, it's funny because when we're talking to somebody about estate planning and insurance comes up, it'll typically be, hey, mom and dad have a $20 million estate tax liability. We need to buy insurance. My quick thinking there is we're either going to look at second to die insurance or single life insurance. We're going to look at the cheapest premium for the most death benefit. When it comes to private placement, it's actually quite the opposite. So I'm going to say to Jim as the client, how much are you looking to invest in this? And Jim might come back and say, we're worth 100 million. We're going to put 10 million of the portfolio into this. What I do there and how we construct these is we're going to come in and say, well, what's the least amount of death benefit I could buy? Because I don't want to pay cost of insurance. I want the cost of insurance in this to be much less than the cost of tax. Otherwise, I would have been better off just not doing it in the wrapper. And so I would say, from an economics perspective, we're all sort of taught compound interest. Putting 10 million into something day one at a certain interest rate would seem it would be better than putting 2.5 million in over 4 years. The reality is with insurance, it's quite the opposite. The 2.5 over 4 is going to perform better. And the reason for that is the IRS is smart on this, right? And they're coming in and they're creating what we call modified endowment contract limits or MEC limits. We have to maintain a ratio between the premium and cash value to the death benefit. And so by spreading the premium out over, say, a 4 or 5 year period, I might have to buy 40% less death benefit than if I put it in up front. So the sweet spot, and look, nobody on the call is going to have to know the designs of these or how, one versus the other, but I would say typically it's tell me how much you want to invest and I will find a spot between 3 and 6 years, which is probably the short duration, the long duration of how to best design that. And then the money is basically sent from the insurance company as it's given to them back to the custodian, and Jim, Mark, and team then put that money to work. So it really is a formula of, I don't want death benefit, but I think as Jim's saying, we have families, we're working with a family right now that has 2 spousal lifetime access trusts up in Michigan. They've got 13 million at each one. They still have about $100 million estate and they have an estate tax liability. They bought some insurance and, they're paying a pretty premium because they're in their late 60s, early 70s. By buying 26 million of investable assets in private placement, their minimum death benefit between the two of them was somewhere around $60 million. Now, again, still better doing it in the wrapper than out of the wrapper, but what it afforded them to do is if God forbid we die early, there is death benefit there. We're not counting on it, but if we die early, it's there. It allowed them to dump their personal insurance that they no longer needed, and it saved them about $400,000 a year in premium. And so great. I think the point there is you got to look at the whole picture. Private placement is an investable piece, but for us, we want to see what is your philanthropy? What is your legacy planning? What assets are where? What are you trying to accomplish? And I think that's where private placement can become a really cool part or component of that investment strategy.
Yeah, I think so. Underwriting, there's been a couple questions on underwriting. Somebody go for underwriting process through this because it is an insurance offering, but what's the underwriting?
Yeah. So, I mean, it's traditional life insurance underwriting. I think what's unique with private placement, in my opinion, over retail insurance is, again, retail insurance, mom and dad need 10 million of second to die insurance, and we need it there the day that they die to pay estate taxes. We're really questioning mom and dad's insurability. Do we insure both? Do we insure one? And are they both healthy or neither of them healthy? When it comes to private placement, again, we're using this really for the asset class inside of that particular ownership structure. So I'm not going to say we'll take anyone off the street. You know, I joked earlier, like your neighbor is, you know, Boston Red Sox. You're not going to pick him because he's great, you know, athlete that's in perfect shape. But if you've got a grandson who's 28 years old and he's in much better shape than grandpa who's, you know, 80 and has had 2 bouts with prostate cancer, we're just looking for the insurable interest. So even if you want to be conservative and say, okay, married couple, male 50, female 51, who do we pick? We pick whoever's better. Is there a health issue? Female mortality tends to be better. Let's put it on my wife instead of me. And so, you know, I think a lot of times when this is being discussed, it is being discussed with the older generation who is worried about underwriting. That's where we say, let's talk about the vehicle. If it's held inside your legacy trust, your grandkids and kids are probably going to be the best choice. So we tend to look for an insured somewhere between maybe 25 and 70 years old. I think anything above 70 is doable depending on health, but that's where we'll start having the discussion. And we don't want anyone below 25 because, believe it or not, an 18-year-old has higher mortality than a 25-year-old due to accidental death. So we don't want to buy too much on a younger person. But the goal really is, Jim asked it earlier, if dad's 80 and we put 10 million of his money into this on his son who is 55 and dad dies, what happens? Nothing. That money keeps accruing inside that portfolio because it's on the son. So we do not have a triggered death benefit until that 55-year-old passes away, which is a great thing.
Yeah. And that's powerful because you have another 30 years of compounding, 20 years.
Yeah.
And that's all tax free. All tax free.
And that's where the family offices love it, right? They want to put it on 10, 12, 15 different family members because you're going to have events happen over the decades. And it's not all at once, but you've got money continuing to work to your benefit on a tax efficient basis.
Right. And and if you do this on some of the legacy trusts that you keep using the word legacy, you know, you have a way of potentially replenishing these assets every generation.
Yeah. I mean, we've seen that on the retail side. We've had insureds come in and say, I'm going to make every family member get insured for $20 million, and it's going to be the spend down and then replace at death strategy. This is a beautiful way because instead of it being an expense, let's buy retail insurance. Let's just have some of that leverage and compounding happen within the portfolio we're investing in anyway.
That's right. That's exactly right. It's fantastic. So it's a great option for that. So, you know, some of the other questions I'm trying to think through that have come up, multiple families, one of them, we covered that. You know, one I've heard a few times is my tax professional says I'm covered. So it's, you know, I'm sure you've come across that. How would you answer that kind of question? I've heard that at least 3 times in the last 2 weeks.
Yeah, I mean, I think that's any industry, any new concept. There's always the fear of, is this the right thing? Is it not? As we said at the start of this, the goal is not to come in and start pitching product. This is a concept that is popular. You will see it. We are seeing it all over the country. It is certainly more popular in places like California and New York and some of the higher taxable states. But, you know, we need to make sure people are educated on it and that it's not flavor of the month or something that's going to blow up on you in the future. And you know, everyone's always buttoned up until they're not, right? So I think the best thing we could do is go out there and say, you've heard it. And if it's not for you, it's not for you. But you know how many clients I've worked with over the years that we present something and then they go back to their attorney or accountant and like ready to fire them saying, why the hell didn't you tell me about this? And they're like, well, I didn't think you'd be interested in it. So you know, again, there's a lot in our industry that we see that is bad news. And I'll be the first to tell you, I mean, even in private placement, I mentioned offshore. I see stuff on a daily basis. I had one out of New York the other day where they were trying to get the 92-year-old mom to sell all of her assets, pay capital gains, invested in this, have the insureds be pension fund people out of Bermuda, you know, take back an intergenerational split dollar note. Like it's just, some people get too cute for their own, you know, their own good. But I think, you know, anyone saying, I don't want to hear about it, we're good. probably, missing an opportunity to see if this might complement what they've already done.
Yeah. Yeah. What we're seeing and hearing about is a lot of it with alternative investments in private equity. You mentioned that earlier, because if you do hold those type of assets, the K1s just go away. If you use private placement life insurance to own those assets, your K1 issues just go away, and that's a big advantage. There's also some things there. My eyebrows immediately go up because you don't want this blowing up in bad private equity and alternative investments either. So you got to be very careful what you're adding into that if you are going to do alts and private equity in PPLI. So
Yeah.
you're seeing a combination of like 50-50. How much are you seeing between traditional investments like we're dividend growth? So traditional asset class versus alts and private equity.
Yeah, I mean, it varies. Out of the 60 that have built this, I would say that some are going all in on alternatives. We're seeing certain firms. I'd say in the multifamily office space, the big buzzword is private equity and access. So, we'll have a client will have a liquidity event for $500 million, and he said, I've met 4 MFOs and we had a good conversation, but they all keep saying we got access. Our fees are lower, this and that. And they're like, I don't know if that's as appealing to me, right? So, but we're seeing fund of funds, we're seeing vintage funds. I would say on average, most of the big shops are maybe putting 20% of the money in alternatives, kind of a traditional 5 to 20. That said, I've got firms out there that are putting upwards of 50 or 60% of this money into alternatives. So, question does come up a lot of like, Jim, how are you and Dividend Assets Capital policed, right? I mean, how do the insurance companies know what you're doing and that it's the right thing? Well, first of all, you got your own internal policing and making sure you're doing the right thing for your clients. But what's important with this is the insurance companies have a huge vetting process that they just went through, and they don't want you investing in crypto. They don't want you investing in, I always look back to maybe 15 years ago when cannabis was the hottest thing out there. They're not going to be the cutting edge of, let's go with something that could take the world by storm, but it could also blow the portfolio up. That said, they're pretty good about alternatives. If you're working with Apollo and Millennium and Bain Capital and, Jordan Companies and Carlisle and some of these big brand names, they're going to allow you to continue to do that. So, there's a lot of policing between the insurance company, the custodian, Dividend Asset Capital, me on the front end helping with the design. But really, I think to Jim's point, we're making sure that we don't put you or the insurance company in harm's way by putting 10 million into something that turns into nothing the next day. And now you're stuck with a bunch of cost of insurance.
Yeah. Yeah. So, anything else? Mark, do you have any questions or anything you want to add from your perspective?
No, I know there's a certain, liquidity requirements within the investment portfolio, depending on in what. So maybe talk a little bit about, from a tax standpoint, or from a not tax per se, but from the IRS standpoint, what are some of the qualifications for those investment portfolios?
Yeah, so I mean, I think again, the first thing is accredited investor is our biggest deal. It's not very hard to pass that. If you're listening to the conversation, you're probably there, right? I think outside of that, there's some diversification rules up front. So when Mark gets my portfolio in, to start out, you have to have a minimum of 5 investments. So I can't just say, here, put 100% into, ABC private equity company. There has to be some diversification outside that investment. It's no more than 55% in one fund, 65 in two, 75 in three, et cetera. I think what's important there is that is not a rebalancing requirement. So if your 10% fund out of the 5 ends up turning into the next Amazon and it's now 85% of your portfolio 5 years from now, you are not required at that point to rebalance it. So, but there is that upfront diversification rule, which, is my way of telling you, you have to have at least 5 managers or 5 different investment options to start the policy. I think outside of that, when it comes to liquidity, the insurance company doesn't want you dying and they're on the hook for 25 million of death benefit, and you've got 15 million of cash value that is all tied up for the next 10 years in alternatives, because they're going to look at it and say, well, how do we liquidate this? And so what you'll find is you could probably aggressively get somewhere between 50 and 60% of the money into alternatives. The rest will have to remain in some type of liquid portfolio. The higher would say that you have more of a staggered. You're not going to have like 10-year private equity, 60% of the portfolio. But if you have 50% of the portfolio as alternatives, and some of them have a 3-year shelf life, some have a 5, some have a 7, that's going to be perfectly acceptable. So, question comes into me a lot of, well, how liquid is this, right? I mean, if you've done any work with insurance in the past, you know that there's surrender charges and there's, certain lockups where these insurance companies don't, take their hooks out of you. And I think in this case, when that question's asked, I turn to Mark and Jim and say, ask them. Really, there's no surrender fees, there's no penalties for leaving. It really comes down to how liquid is your portfolio. So if 80% of it is sitting in the dividend portfolio and it's a liquid equity portfolio, then you're in good shape. If 20% of it is sitting in alts that has a 3-year shelf life, in my opinion, you're no worse off in the wrapper than you would have been out of it. You're going to have that same illiquidity. But I think the point is you can be nimble, you can be flexible with this. If you commit to $2 million a year for 5 years and year 3 hits and liquidity's tight, you say, I don't want to put that third payment in, you're not going to get a penalty. So really this is meant to be that wrapper for you to invest with your money manager and really take away those K1s and 1099s with the hope that you will compound wealth at a greater pace.
Talk about taking funds out.
Yeah.
So if you commit, $2 million a year for 3 years to $6 million, talk about actually pulling funds out of this and from that standpoint.
Yeah. So, I mean, look, any insurance policy, whether it's a whole life or a retail variable or a private placement, you have those benefits of tax deferred growth, tax-free access. So how do I access my money? Well, the first way is I can withdraw my cost basis. So if I put in $2 million for 5 years, total of 10, and 15 years from now, it's worth $50 million. The first 10 million that I pull out of this is going to be a first in, first out withdrawal of basis, no penalties, no interest, no loan. Just here's your money back. Any dollar above that has to be taken as a policy loan. I can't give you an additional withdrawal because the IRS will look at that as income. So I give you a loan against your death benefit. The intention is that you will never pay this back. You'll pay it back at death out of that death benefit. And again, if you have insurance experience, there's the aha moment, right? Yeah, I saw one of these, the whole life policy, and they were charging me 8% compound interest, and it killed me to get my money. Insurance companies are not making money off of private placement policy loans. You will see that most of these policies charge like 1.2% on the loan, and they will credit you back somewhere around 100 basis points. So the net cost of loan on these will go anywhere from as low as 5 basis points to as high as 20 basis points. So the beauty here is that 50 million example I gave, I can pull my 10 out without any interest. I can take maybe another 25 out with interest compounding at 0.2% a year. And then, well, what's the catch? Why can't I take the full 50? Well, the full 50, the problem is if I ever surrender or terminate this policy and take my 50 million of total value now, at that point, the IRS is saying, well, wait a minute, we're giving you all the tax benefits of this wrapper. You just terminated it. So we're not going to give it to you anymore. We're going to tax you on the gain in the policy, which is the 40 million, 10 that you invested minus or plus, you got the 50 of total. That 40 is the difference. What I have to stress is that is not gain. That is income tax. That is a huge deal, right? So when people say, why wouldn't I do this? I would not do it. I would never recommend it if your goal was to grow it and pull it out, because you're better off doing that in a capital gains environment than an income tax environment. So what do I have to leave in? Well, it's going to vary by age and when you take the loans, how early, how late, how old are you at the time you're taking them. But I would say general rule of thumb is you probably got to leave somewhere between 15 and 20% of the portfolio in there until you die, and then that'll be paid out as a tax-free stepped up death benefit. So in the case of the 50 million, I can probably pull somewhere around 35 million out of this and I will be fine. And the other 15 will continue to stay invested and will then be paid out as death benefit. My pushback is, why would you pull a significant amount out? I mean, I think our clients want to know it is accessible. It's not going to go in this steel trap and never be accessible to them. But other than, hey, I want to buy the kids a house for $5 million, or hey, I got a major expense I got to pay, I want to pull 10 out of that. I don't see a situation where a client wants to pull 48 million out of the 50 and move it right over to the brokerage account that's in the taxable environment, right? So I think a lot of these turn into legacy deals where it's nice to know I can access it, but they grow.
Yeah, but you also have some clients just from the ability of mindset and is, I know it's there. I can access if I need it, even though I don't ever plan to touch it. I know that I can, if I absolutely have to get to it, I can get to it.
Yeah.
That's the That's the
And that's
mindset.
where it's great with the multi-generational family members, right? I mean, if we got 25 policies on 25 different family members, I can pull 3 million out of one, 4 million out of another, 6 million out of another. I can create portfolios of wealth just by grabbing money out of each of these different insurable policies.
Right, right, absolutely. So, but we're just about bumping up against time here, and if anybody on today's session has any questions or wants to know more, please reach into this office, and we will also be this has been recorded, so we will actually be editing it just a little bit and then sending it out to you all, so that you can listen to this again at your leisure. And the reason why we're doing this, Matt, as Matt said, this is a tool and it is out there and it is an option. And for most of our clients that we work with here at our firm, they need to know that this tool is available. Whether or not they use it or not, that's completely up to them, but they need to be aware and know that this tool is available. So that being said, Matt, we really thank you for your time today and doing this. And for you all on the call, just to let you know, Matt is actually in our office today. So we're doing this session he's in the next room. So we're looking forward to building this rapport with you, Matt, and your firm, and look forward to hopefully working with some clients with you down the road and at least exploring this for them. So everybody on the webinar today, thank you very much for your time, and look for this recording in your inbox in the next day or so. So have a great rest of the week, everybody. Thank you.